don't own assets, then you're being left behind because your wages are not keeping up. You are falling behind in even being able to buy those assets. That's the greatest challenge for this next generation.
But the reality is, if you're not making at least 10%, you're actually falling behind, not even keeping even.
And that's the frustration that people are starting to feel it. Their wages are going up. They're like, I got a 5% raise, but I still can't afford the things I used to be able to afford. Why? Well, it's because those numbers are manipulated. It's evil. It's demeaning. And the young kids in their mid-30s, they're struggling to even buy a house because it takes so much more income now to buy a house than it used to. And the election cycles bring a lot of uncertainty. And once you get certainty in the market, when you had certainty that Trump was going to be elected and that he is elected, well, Bitcoin ripped. Why is that? Well, there's a few reasons.
What's the one thing happening right now that most people don't understand but absolutely should if they want to survive financially?
A lot of people in just the normal world don't understand how the money is being debased right underneath them. The numbers of inflation are being manipulated, and now they're really just being stolen from every day. They're being told that if you buy a bond, if you buy T-bills or treasuries, then you can keep up with it. It's not true.
All right, James, you spent the year analyzing global markets. And let's be honest, right? The financial system is barely hanging by a thread. So what's the one thing happening right now that most people don't understand but absolutely should if they want to survive financially?
A lot of people in just the normal world don't understand how the money is being debased right underneath them. They just assume that inflation is a natural thing, and they don't see just how badly it's being manipulated. The numbers of inflation are being manipulated, and now they're really just being stolen from every day. So the system forces people to take risk to keep up with that debasement. So they have to buy risk assets. They have to invest in real estate. They have to invest in things, stocks and gold and whatnot, in order to try to keep up with that inflation. They're being told that if you buy a bond, if you buy T-bills or treasuries, then you can keep up with it. And it's not true. So the money supply is expanding at such a rate that they can't keep up, and they're getting a negative return on whatever dollars they leave invested there. So they go further out, and then some people are realizing that. So they go further out on the risk curve in order to try to catch up. And a lot of times it just doesn't work.
So would you say they don't understand mechanically what's happening? So I think most people know they should probably be investing, but that's because they think they want their money to grow so they have more money in the future. Mm-hmm. But maybe they don't realize as much that it's not just you want your money to grow so you have more in the future, but you actually have to outgrow the rate of what you're losing. Is that what you're saying?
Yeah, exactly. And so, it's like you're just trying to pick a horse that will keep up with all the prices around us. I just went down the street. Great place here, San Clemente, love it here. But to get a taco, and a breakfast taco is like $9.80 for a taco. I mean, it's just insane, right? Yeah. So, the reality is that people feel it. They feel like the prices are going up, but what they don't, and they think they buy something and it's rising in value. What is actually happening, and this is what's misunderstood, is that it's holding its value better than what the underlying currency that is being priced in. So if you get a piece of real estate that rises in value faster than the debasement of the dollar meaning inflation. So if it rises faster than inflation, call inflation today 3.5%. And if your beachfront property is rising at 10%, well, you've made a good call. You bought the right horse. It's highly desirable. There's not, there's only so many of them, so it's limited in supply, being beachfront property. All right, good call, But if you bought a stock that was a high flyer and you thought, oh, this is going to keep going up, and it crashes, that's a bad call. And now you've taken that risk to try to outpace that inflation, and you've missed it. And now you're starting at a place that's even further behind.
You said that inflation's 3%. That's a government-reported number of CPI. I don't think that's the real inflation number, or the number we have to beat. Is that the number we need to beat?
Well, that's the number that people are told they need to beat.
Right.
But they're told two things. They're told that inflation is natural, and you need it for the economy to grow. It's not true. It's and you and I talk about this quite a bit about how technology should actually make your life better with cheaper things. You know, the more the technology advances, the cheaper things should become, right? But it doesn't happen that way. Why is that? Because they manipulate the money supply. So let's talk about that 3%. Well, that 3.5% that we're talking about, that is way above the 2% inflation rate that is supposed to be the target. Well, that's what they've been reporting. But we well know that the actual inflation rate is much more closely tied to the expansion of the money supply. And then if you look back to 1971, when we got off the gold standard, money has been expanding by over 7%. They're slightly different measures, but between 6.9 and 7.1% since 1971 annually.
Right. And even faster in a shorter time period. So 10% since 2019. So do you think, back to sort of what you said, what they don't understand what's happening right now, but they should if they want to survive, is also that the number you need to beat is a lot higher than you think it is. You've been told it's 3%. Your financial advisor's telling you you're making 4 or 5%. You're doing pretty good. But the reality is, if you're not making at least 10%, you're actually falling behind, not even keeping even.
Exactly. And that's the frustration that people are starting to feel it.
Yeah.
They're feeling that frustration. They don't understand. They see that, you know, their wages are going up. They're like, I got a 5% raise, but I still can't afford the things I used to be able to afford. Why? Well, it's because those numbers are manipulated.
Yeah.
And it's because certain things are moved in and out of baskets of the CPI basket to make those numbers look a certain way. You know, it can get political and all that, but the reality is insurance costs are going up, or auto repair, or, you know.
Supposedly the CPI number that came out the other day showed insurance was dropping.
Right.
I haven't seen that.
I have not seen that.
Yeah.
Yeah. So, and that's the problem. And so people are frustrated, and this all goes into that, you know, the propensity for people to take on more and more risk to try to keep up. And if you think about it, it's evil. It's demeaning. You're working so hard, you're trying to keep up, you're getting your raises, and you're falling behind, and you can't afford things that you used to be able to afford. And the young kids, you know, the kids who are just getting out of college, 20, 30, and in their mid 30s, they're struggling to even buy a house because it takes so much more income now to buy a house than it used to.
Yeah.
And that all is this has all been feeding into that.
Yeah. So I know you talk a lot about what feeds into that, and debt, and you know, the macro cycle and things like that. So how bad does this actually get? And then what happens to the people who don't shift their investment strategy in time?
Yeah. Well, I think it just continues the way it is for a while. It's just perpetual high inflation for a long period of time. You know, we're seeing now some really, in my opinion, good things, excellent things are going on in DC now, where you've got the DOGE Commission, Department of Government Efficiency, with Elon and Vivek, but they're cutting expenses left and right. They're finding just insane expenses that they're cutting out, and that's good, and that will help. And
I think so far they're finding them.
They're finding them. Yeah.
We'll see if they cut them out.
Agreed. And there's gonna be a lot of fighting on that, but the reality is the math is so bad that it doesn't really matter. The debt is going to keep expanding. We're going to continue to operate in deficits, and we're going to have to continue to borrow money, which is inflationary, and that feeds into this whole, you know, cycle. So your question is, how bad does it get? Well, it can get pretty bad. It can get if you look at the inflation rate over the 1970s into the 80s, you saw inflation went up. It came down, it kind of stabilized, and then it went up again, had another spike, and it kind of another hump in the camel's back. And we're following that trajectory almost to the T in this same cycle, where the Fed they pumped a bunch of money, and they realized they made a policy mistake there, and so they raised rates, and so inflation ran. It's come all the way back down, but we have such massive deficit spending coming out of DC, that we have fiscally driven inflation, and that's just continuing. And so it's kind of picking up again. So it could get really bad here, meaning that we hit 10, 15, even 20% inflation for a short period of time. It's possible.
Wow.
Do I expect that? No, but I do expect us to just continue to have this high perpetual inflation, whether it's 5, whatever the number that they're measuring and communicating. The reality is it's probably closer to 7 to 12%.
Yeah.
So, it just means that over that period of time, though, this is another thing that people don't realize, is that 7% annual inflation compounded over years will eat into your earnings and your discretionary income. It can eat into it 40, 50, 60, 70% in a decade.
Yeah.
So that's the problem.
Yeah. Where you're buying 50% less goods and services in a decade from now. Because of the way it compounds like that. At the same time, I mean, all of that deficit spending, all that money printing, all that debt, we're also seeing like the largest gap in income inequality we've ever seen. So then it does seem like some people are getting rich and some people are getting poorer from this. So, I mean, looking at charts that show this wealth inequality gap growing faster and faster and faster, bigger and bigger and bigger. I mean, is this the big wealth transfer that's happening right now?
Yeah, it's the people who own assets. You hear about the boomers have made out so well. They're living large. They're living in these huge homes. They're worth so much money. And the reality is, the older demographic is typically the demographic that owns assets. And the ones who own assets have done well because you've had a massive amount of asset inflation as we continue to print money. And so that's it. That's the crux right there. If you don't own assets, then you're being left behind because your wages are not keeping up. And so you are falling behind in even being able to buy those assets. And so that's the greatest challenge for this next generation is how do you get some assets that you can hold for a long period of time that will outpace that expansion of the money supply, which leads us exactly to why we do what we do and why we're so focused on Bitcoin.
Yeah. So if you look at like that real rate of monetary debasement as being inflation, 10%, 12, 14%, and then you look at all the different asset classes. So then you go, okay, well, what asset classes do I have to invest in that could beat that? I just saw this video the other day of Ray Dalio talking about, well, the way that you want to build wealth is you want to invest across 15 different asset classes. This was just a couple days ago. So he's still pushing this all-weather portfolio. Problem is that all-weather portfolio doesn't make any money. They've had over $70 billion in redemptions in the last several years because it just doesn't make any money. And I think it goes back to, why would I invest through 15 different assets if none of those assets are keeping up with or beating the rate of monetary debasement? And so when you look at it from that type of a lens, which is sort of how I look from it, then you see that the only things that have beat it are tech stocks in the NASDAQ and Bitcoin. And that's it. So what we see is that different assets soak up that extra liquidity at different rates. And I think that's what separates the winners and losers. And it doesn't seem like factually in history, Bitcoin has soaked that up at the fastest rate. So why is that?
Yeah. I mean, obviously to you and me, Bitcoin it's sound money. It's hard money. It's something that cannot be debased. There's only going to be 21 million Bitcoin ever minted, ever created. And so it can't be manipulated like fiat money supplies. And even like gold, we've seen the madness out in London this last week, last few weeks, and what's happening there. And this is kind of an important thing because people think, oh yeah, but I buy gold, then I'm protected. But gold, I mean, if gold was not so manipulated, it would be at a much higher price. It would be, in the tens of thousands. It wouldn't be just hovering around 3. And so the issue there is that you have sovereigns buying gold. You have some worries about Trump tariffs and bringing your gold back into the States and having a sudden tariff on it. So you've got the COMEX is bringing gold back into New York and into the United States. And so you have players around the world that are buying gold, like the BRICS countries, to try to avoid having to buy U.S. treasuries in order to have dollars, because everybody still needs dollars around the world. But if you have gold, then you're supposedly protected. Well, the issue in the last few weeks out in London, is that the Bank of England realized we don't have all the gold in our vaults. We can't just send it out. So it's going to take us 4 to 8 weeks to get you your gold. Okay, so then think about that. You've got 4 to 8 weeks before you can get your hard asset that is supposedly hard and being held in a vault for you. Okay, that's number one. Then you've got to transfer it. You've got to transport it, which you've got to put it on. You've got to put it on a truck and a plane or a boat or something on rail to get it to wherever you need it to be. And it's got to be protected. So you have to pay for security for it. It's very heavy stuff. And they even said it like, this is heavy. Yeah. The Bank of England was on stage at a press conference saying, well, it's really heavy, so it takes a while to move.
Yeah.
So if you want to move $1 billion of gold, think about all that would take to do that, to get it from London to New York. Then think about something like Bitcoin, where you have verifiable addresses and it's immutable. And that you look at that address and you see exactly how much Bitcoin is in that part of the blockchain, right? It's very easily auditable. You don't have to worry that it might be just gold-plated nickel. Like you saw in the JP Morgan vaults, they had $50 million of gold-plated nickel by accident. They didn't know about. Well, you know that's not going to happen. You can move it. You can move $1 billion of Bitcoin in less than 10 minutes for a few bucks.
Right.
It's staggering, and people are starting to catch on to this. And so the younger generation is very comfortable with that digital asset, that concept. The older generation, not so much. They love the gold, typically. My mom loves Bitcoin, but you have the younger generation now is looking at things like digital assets, and Bitcoin is one of those digital assets that is starting to bring people over to a new asset class, and it's emerging and it's growing rapidly, and that's the point.
Do you see sort of like this bifurcation happening in the market, where you mentioned like the older generation, the younger generation? I'm not sure if I see it that way, but I do see a bifurcation happening where you see massive demand for gold through central banks. Mm-hmm. Their demand for gold is at all-time highs the last couple of years. You mentioned BRICS nations, China trying to divest from treasuries, things like that. So you see the governments and the central banks sort of clamoring for the gold. But when you look at a little bit lower down, when you look at the institutions, even when you look at like government sovereign wealth funds and then down to institutions in Wall Street, it seems they're more into buying Bitcoin right now. So I see announcements almost every day of new publicly traded companies adding Bitcoin to their balance sheet. Mm-hmm. I haven't heard of any that are adding gold to their balance sheet. We hear about sovereign wealth funds. I think just today, was it Saudi Arabia or was it Abu Dhabi announced they had $460 million worth of Bitcoin added, but you didn't hear about them adding gold. So it's almost like this bifurcation where the governments and central banks seem to be acquiring gold at a rapid rate, but then everyone just below that, sovereign wealth down to institutions and banks, are going into Bitcoin. Is that what you're seeing?
Yeah. I mean, it's fair. Exactly. And just going back to what we're talking about, that the inflation, keep up inflation and demographics, that's one side of it. But what you just hit on is it's probably this is the key development for Bitcoin in this last 18 months. You've had massive tailwinds for this asset class, mm-hmm. and we can talk through each of those. But just like you said, you have these sovereign wealth funds, institutions, very large, high net worth individuals coming into this new asset class because they know that and this is all game theory now, is that I need to get some of this before the price gets away from me. And then people look at it and say, oh God, it's $100,000. It's too late. I can't afford a Bitcoin now. Whereas, you and I know that that's just a number. Like the debasement's not going to stop. This is going to continue to go up in value, meaning the dollar is going to go down in value against it. So they're not sensitive to price like retail is. Like, some of the smaller players are, who only have so much money. They're very sensitive to the price of Bitcoin. Whereas you have Abu Dhabi come in, they could buy $500 million of Bitcoin,
And they did.
Hey, just go along in the market. Like, I'm not price sensitive. I'm not waiting for it to get back to 70.
Yeah.
Just participate and go along in the market. And that's what they did. And what's interesting about that is they bought the ETFs. Apparently, from the report, they bought ETFs. And so people would now say, wow, but that's just paper Bitcoin. It's not. The ETFs have a legal obligation to own the underlying Bitcoin. If you're a spot ETF like IBIT or like, FBTC or Bitwise, you have to own those, the corresponding amount of Bitcoin to the NAV. Okay. So, but that is an easy way for any player to get in. Sovereign funds, governments, institutions, endowments, pension funds, they can just buy the ETF now. That's a super highway that's been built.
Yeah.
It's so easy for them to get on that. So institutional adoption is happening. It's happening quietly. You do see companies coming in and buying Bitcoin. You do hear about companies buying actual Bitcoin on their treasuries. But this is kind of like, it's all now forming and taking shape in exactly what you just said. It's becoming adopted as a new asset class.
Yeah. Right before our eyes. You mentioned earlier, like sort of like the Bank of England and the LBMA, London Bullion Market, and as well as the BOE, Bank of England, both running out of gold. Mm-hmm. The world's clamoring for gold, trying to get it from wherever they can. I think the LBMA had 320 million ounces on paper, but like 400 ounces of claims against that, but only 30 available or something like that. It was crazy. But what we're seeing now, everyone's clamoring for gold. We're starting to see that a lot of these ETFs have leased out their gold, right? So that's like that rehypothecation. Exactly. So when you talk about like the Bitcoin fund, they're legally required to buy it, but are they allowed to? Are they restricted from leasing it out and rehypothecating it like we see in the gold market?
Well, they're not supposed to be rehypothecating the Bitcoin. So gold, yeah, I mean, they have ways to do that clearly, and that has been the problem. That's been the fear of people who own these ETFs. Do they actually have the gold in the vaults like they say they do? And it's hard to audit that. But again, with Bitcoin, you can audit it in minutes. Just you can just have your spreadsheets and audit it. It's not, it won't be difficult. So,
yeah. Now, most people think like, well, I don't know about most people. I get asked the question all the time, like, how do you invest into Bitcoin? It's like, you can just buy it and like you just hold it, right? And so I think maybe most people that then think about it that way would go, well, I guess I just buy it and I hold it. But like, you worked in the big hedge funds, you worked with the institutional capital allocators. Like, what's the difference between how retail thinks about Bitcoin and like institutional allocators and like hedge funds would approach Bitcoin?
That's a good question. It depends on the type of hedge fund. And so if you're an active hedge fund, like really actively managing your capital and you're trading a lot, then you'll be trading Bitcoin and you'll be going long, you'll be going short, you'll have all kinds of strategies around it, put call strategies, you might be doing derivatives with it. You might be doing hedge trades against or pairs trades with other currencies. There's all kinds of stuff that hedge funds will do with the base currency, with the base asset. That's one type. Another type is, you'll be buying companies that are either involved with or are investing in Bitcoin themselves, things like Strategy, former MicroStrategy, Metaplanet and other ones, Bitcoin miners, obviously. So that's another strategy. And then you've got, so that's kind of like the hedge fund world, non-endowment or pension funds. They would just be buying Bitcoin. Like, they're not going to be doing all this stuff. They might buy some of these stocks, but probably through some other agent, through a hedge fund or through another money manager, probably. But then on the other side, so it's got kind of like, just the regular hedge fund side. You've got your VC side, which is the venture capitalists are buying super, super early stage, highly speculative, very young companies, not typically just not revenue generating. And so, but they have a basket or a portfolio of these investments, and they hope that one or two of them become unicorns to make the returns for the whole portfolio, because the reality is that most of those companies don't really make it after 10 or 15 years.
Yeah.
That's just the reality of VC investing. On the other side of the spectrum, you've got companies like investment companies or hedge funds that will invest in revenue generating companies that are a little bit, they're longer in the tooth, that are revenue generating, they're up and running and have this window of 5 or 10 years where they'll really grow rapidly along with Bitcoin. And that's kind of in my mind, that's kind of a sweet spot of this industry right now.
Yeah. So the way that I kind of think about that is like, so you have this whole stack as you're sort of describing it to us. So you can buy the base asset, you could buy the Bitcoin, and then there's other ways to play it. Companies that are exposed to Bitcoin, building on and around Bitcoin, things like that. So if you think about like oil is a commodity, oil's an asset. Maybe the last 50 years, adjusted for inflation, it hasn't really moved anywhere. It's $60, $80 a barrel, something like that. But then you have the oil industry. That's like the 8th largest industry in the world, worth about $5 trillion, 4.7, I think. So you sort of are seeing the same thing then. So you have Bitcoin, the asset, the commodity, but now you have this industry being built around Bitcoin. And then I think what you're saying is, just to kind of reiterate to the audience, is that you have, just like traditional tech, you have like early stage, like breaking ground, and that would typically be like friends and family, angel rounds, super high risk, high reward. And then you go up the stack to higher level companies that are further along. They need bigger amounts of money. They maybe don't have those potential rewards, but also they don't have that risk as well, because they found market fit and they're producing profits. So you're basically seeing that exact same scenario, tech, now coming over to sort of this Bitcoin ecosystem. Exactly. Or maybe the Bitcoin companies are moving over to the tech ecosystem.
Yeah, and that's exactly what we're seeing. And so the hard part about investing in this space is, like you just said, people are like, why don't I just buy Bitcoin? Why don't I just buy Bitcoin and hold it? And that would be, I think people should. That's your first core investment. But then you're trying to find those companies that are well managed, that are disciplined, and are actually that give you a better risk reward, right? So that risk reward is what you just said. Is it very, very, very early stage where it's a super high reward but a super high risk, or is it kind of in the middle where it's a high reward but a lower risk, or is it a little bit further along where it's a solid reward but a much lower risk? So that risk reward here could be much better than over here.
Yeah.
Especially when you put it into an entire portfolio.
Let's talk about breaking down that risk and reward. I've done venture deals for a decade. So like, again, right, like I could decide which stage I wanted to invest into based off of where I wanted that risk reward profile to be. But like typically if I was thinking of Uber, for example, I would say, well, how'd you come up with this valuation? Well, we're going to disrupt taxis. We're going to disrupt limos. We're going to disrupt vans. We're going to disrupt, right, all these things. And it combined, the TAM, the total addressable market, is, 100 million or whatever, billion. If we capture 5% of each of those markets, we'll have that valuation, right? So there's like a math equation. I can sort of see, well, I think it's realistic that it could take a little bit from each of those industries. It could disrupt that. Okay, we can get to 100 million or whatever that valuation is. But when I think about it from like, it's easy to sort of understand disruptive tech in a world that we live in today. But when you have something like Bitcoin that's like building a world that we don't even know what that world looks like, it's really hard. It's really hard to imagine this new world when we're living in this world that we have now. So then we have these new early stage Bitcoin companies that are going to go disrupt markets. But how do we measure the future value if there's not a market they're disrupting today? So how do we know if it's going to be 5 million, 10 million, 20 million, 50 million, 100 million?
You just hit on exactly why we are extraordinarily picky in my fund
The Bitcoin Opportunity Fund.
Bitcoin Opportunity Fund, where you're a GP, and also we're super choosy and disciplined on what we invest in early stage, and that's because it's very difficult to put a valuation on something like that, and often the valuations are just pulled out of thin air. Exactly what you just said. Well, the addressable market is this, or the reality.
How do they even know what the addressable market is? Because there's no market they're disrupting.
No market to disrupt, exactly. So the reality is, you're typically then mostly putting your trust and your risk capital on what you believe to be the best operator with the best idea. So you're trying to lower execution risk, but the reality is an execution risk is massive when you're in early stage. I mean, you've started companies, you know what it's like. It's so easy to get tripped up in a plethora of different ways. So,
but that's the operational risk of if I can achieve what I say I'm going to achieve. But at least I'm able to quantify even if you do overcome the operational risk and you do achieve it, then how much would it be worth?
Yeah. Well,
so if you do get 5% from taxis, okay, I could see how you're worth that much if you can get over the operational risk hazard. But in a case where there's no market that I'm disrupting, so I have the risk of the operational risk, right. But then how do I know even how much value we might have, right? So for example, in the VC space in Bitcoin, you might see a bunch of wallets. There's a whole bunch of wallets. We're going to integrate Lightning into it or whatever, right? But what market is that really disrupting? I mean, how much value could that really create, for example? And that might be a too simple of a version. But I just don't understand these values because as an investor, we're trying to discount the future.
Exactly, but you don't know what to discount.
Right, I don't know what to discount,
and that's what makes it so difficult.
Do you think it's also like where we're at in the cycle as well, right? Where it's I think both of us obviously believe in that future, but is it going to come in 2 years or 5 years or 10 years or 15 years is a question. And I think you want to kind of find the answer to that out first, because then that helps you decide at which level you want to invest into.
Yeah, that's the point, is that the duration of those investments might not match the fund, right? So the duration of a super early stage investment, a company that's just starting out with an idea on a napkin, that might be a 15-year runway on a 10-year fund. So that doesn't really work. That math doesn't work, right? So that's a problem. It's a mismatch of duration. So that is one of the advantages of investing in companies that what they're doing. They have revenue generation. You can see that you've got a little bit clearer vision of that runway in a 5 or 10 year window, or even 3 to 5 year window in some of them. So it's just a different way of investing for sure.
So with these, typical VC funds that are investing at the early stages, the real early stages, and they have a 10-year time frame, you mentioned sort of like this mismatch, if you will, or maybe these companies aren't going to be profitable for 15 years, but the fund's only 10 years. I'm curious, in that model, not that you run that, but I know you've been in this space for a long time. In that model, how are they showing profitability and growth to attract new capital through those stages if those businesses don't really have a liquidity event?
Right. Well, this is it's difficult. It's challenging. So what typical VCs will do is, you'll have your angel funding or a Series A, and then it'll be at one valuation. So let's say that you bought 10% of a company that you valued at $10 million. Then you do a Series B, and the company's further down the road, and they say, well, we've created this value. We're worth more money now because of the things that we've just been talking about, that, now we can do this, or we've got IP that might be valuable or something. So now we think we're worth $20 million. So for that same 10% position of Series B, now you've got to pay $2 million. Okay. So, but Series A has now had 100% markup to $20 million. I'm using very simple,
Sure.
math here that it's not exactly like it, but this is close enough that now you've had 100% markup. So now your first position is up 100%. And so however much, if it's 50% of your portfolio, now your portfolio is up 50%.
Right.
Or if it's 25% your portfolio is up 25%. So that's how they're showing returns along their IRRs along the way. And that's until you have an actual exit, which may or may not happen for a while.
I mean, I suppose on one side it shows that there's demand. So like maybe someone will pay that price if they're paying that number today, but not if I'm leading that round.
Right, exactly.
Right, because it shows I'm paying more than I paid before.
Right.
Which is typically done in the VC space anyway, right? I mean, they typically invest through multiple tranches.
Yeah, and they'll invest in the same company over a period of years and use Fund 1, Fund 2, Fund 3, Fund 4 to do Series B, Series C. Yeah.
But I guess it's just important for investors looking at that to sort of understand the mechanics of that. It's typically done, so it's not like it's like a shady thing. No, but it's just understanding like it's not like real revenues and real profits. It's more of just like sort of like a back of the napkin or inside math type of situation.
Yeah, I mean I sleep well at night knowing that if I liquidate my portfolio, if I liquidate the Bitcoin Opportunity Fund right now, I give back the investors exactly what's on their investment statement because it's marketable securities plus some of those privates that are marked at cost.
So where do you think some of the biggest asymmetric bets, and I maybe that's even the wrong word just because that just thinks fully on reward and not enough on the risk, but where we're at in the cycle and the maturity and sort of, as you said, sort of the time frame of the fund, where do you think some of the best kind of areas in the Bitcoin ecosystem are sort of the best to return money over the next 5 years or so, let's say?
Yeah, I mean, the obvious answer would be in the public space, miners. Certain miners, not all of them. We don't own all the miners. We own certain miners in specifically because of their energy assets, their ability to leverage off those assets. They have optionality with them, especially with this really, really fast growing AI space and the hyperscalers. And so, the companies that control like scalable power assets, they have the ability to secure those long-term contracts from AI hyperscalers, the AI companies that are going to need massive amounts of computing power, like those are very interesting to us for two reasons. Number one, they can be high revenue generating companies for years, and you could see kind of that window, and you're starting to see these contracts come forward, being pulled forward, and so that's one thing. And the second thing is they become M&A targets themselves. So it's kind of an event-driven play as well. And you can have a basket of those that are event-driven that could be takeout targets in the future, likely will be takeout targets in the future from either larger players in the space, larger miners or larger power companies, or some of, like the data center REITs, for instance, that they might want to take them out. So it's a really interesting space for us on the public side. And then there's a lot of things that are in the private side that are bricks and mortar, but have some sort of Bitcoin element to them. So they're already mature. They're already they're already revenue generating. They're successful companies, but then now they're adding this element of Bitcoin to them that they can leverage off of that base platform and do really well from.
Yeah. I love to study the cycles, and I look at like these like 50-year cycles that happen, and each one of them is it's not represented by just one single piece of technology, but it's always a cluster. And the reason why it's a cluster of technologies is that together combined, the sum is greater than the parts, right? Together they're combined, they give you like these new sets of building blocks to build things that you just didn't imagine before. And so like we have like Bitcoin. I've been calling it the decentralized revolution for like 4 or 5 years because of where I think we're at. And I think we're starting to see that now, right? So you have like Bitcoin, which is a decentralized technology, but then you have AI. So you just mentioned like AI hosting, AI processing going to like these Bitcoin mining facilities. We're also seeing a shakeup in the AI market, the tech market, the NASDAQ, if you will, where like, and it's almost kind of going the same thing the internet did, same thing that crypto and Bitcoin did as well, where like you almost had like value accruing at these like monopolistic LLMs. So you had OpenAI and Google Gemini and et cetera. But now all of a sudden you have all these open source ones. Facebook, Meta launched Llama, which is open source, maybe just to sort of blunt what OpenAI did. Now, if China's dropping a new one, it seems like every week. And so it's kind of pushing that down to almost more like a decentralized level. And so I think that's kind of interesting. But I guess the question I was going to ask is like, so the cluster, so now we have like AI and Bitcoin sort of working together, like synergistically. And it seems like that's going to be really valuable. We're not exactly sure where that's going to be. I did see recently like these AI agents that people are buying. They're able to get them to start transacting autonomously using Bitcoin Lightning.
Crazy, yeah.
Yeah, someone ran one where they literally had the AI agent go research a domain name, find the domain name, and go buy it with Bitcoin Lightning. The whole thing was pretty cool. So I think about that. So one, you mentioned the data centers, like being able to use Bitcoin mining and the high compute for AI being a really big thing. But also some of these cutting edge ones that are like just starting to pop up. I mean, do you think that's an area that you'll be focused on?
Oh, yeah, absolutely. And that's exactly what we're looking for. We're looking for those opportunities where there's those two technologies that are successful in and of themselves can be merged and create more value being together than they would separately. And obviously that's exactly what we're looking for. That's kind of like a nirvana thing.
Yeah.
For instance, one of the things that we're working on for the second fund, it'll be in the first fund too. But one of the things that we're working on is what we're calling is the first, Bitcoin leverage buyout. And so what we're doing is we've been in deep due diligence with a successful and experienced operator who's had success in other businesses. And what we're working on rolling up a non-cyclical industry, like an industrial service business. I can't really say too much because we're in NDA, but it's solid cash flow, and we would leverage the business, right? Utilize a Bitcoin treasury strategy, and then we would be providing equity capital along the way, and then obviously advise on debt structuring for the different acquisitions, and assist in the Bitcoin treasury. But these are businesses you can buy at 3 to 4 times multiple on their EBITDA, their earnings, and then turn around once it's all rolled up and sell it for like an 8 or 9 or even 10 times EBITDA later down the road.
Yeah.
So that's kind of a strategy. That's really late stage. That's like, it's private and it's late stage, but it's something where we can leverage both our experience and exactly what you just said. You're taking a bricks and mortar business,
yeah,
and something that is that's stable and cash generating, and then adding that Bitcoin element to it, and then you get this tremendous valuation on the backside of it.
Yeah. Now let's jump into some fun stuff with the crystal ball that neither of us have.
We love this part.
You mentioned earlier, some people may be thinking it was too late, or maybe it's too late. Bitcoin hit 100,000. First of all, I would just say to anybody, just to kind of throw this out there, first of all, you can buy $1 worth of Bitcoin. And really, you can sort of do that with anything. So, I mean, certainly not a house. You can't buy $1 worth of a house. I mean, I guess there are some crowdfunding ways you could do that and tokenized house. But for the most part, a home to live in, you don't. But for the most part, the key that you laid out for us in the beginning is that you're being debased faster than you think. You need to buy some assets to keep you ahead. And so you should do that. And you said that the rich are getting richer and the poor are getting poorer because the rich buy assets. So everyone should just buy assets. And I know that sounds super simple and maybe insensitive to some people who are living paycheck to paycheck, but put $1 in, put $5 in, put $10 in, build that discipline. But specifically back to the point of you saying, some people think it's too late because they hit 100,000. In my opinion, those people are living life in the rearview mirror. Mm-hmm. I remember,
Good way to put it.
I started my career in real estate. 2008 wiped me out and everyone else that I was working with at the time. And I remember like around 2012 was when the real estate market really bottomed out. Mm-hmm. And then Florida got hit super hard. And I remember like 2014, 2015, Florida was roaring back. And a bunch of my real estate friends were like, oh, it's just too expensive. It's too expensive. It's too expensive. Because they were comparing it with being too expensive to 2012. Mm-hmm. at the bottom, not compared to the rest of the U.S. real estate or not compared to the terms and all these things. And it went on a tear. So when you look at $100,000 Bitcoin, that's like looking in the rearview mirror, as opposed to like, where is it going in the future? So,
that's like Oscar quote right there.
Right.
You go to where the puck is going.
Go to where the puck is going, right? So what's a way or a couple ways that you think about how you sort of measure where Bitcoin's going?
Yeah, I mean, we talk about this a lot. You and I we just pulled up the chart before the show, taking a peek at it. The global assets, the total global assets. Jesse Myers puts this out, and that chart. And kind of, it's funny. I made the same exact chart, and then I saw his in Saylor's presentation a couple days later. We were like maybe $10 trillion off here and there on the big pieces. But they look almost exactly alike. So the reality is it's a pretty definable set of investable assets in the world that doesn't include the derivatives. So if you just look at the investable assets, it's $900 trillion. But in that, Bitcoin is now $2 trillion. So it's a really easy way to visualize these big blocks that Bitcoin can start taking market share away from. So you've got gold is about 18 trillion. Then you've got your money supply and your real estate over 300 trillion. You got your bonds 300 trillion. You've got your stocks 120, 130 trillion. So where does Bitcoin start taking market share away from? Meaning, where do people start taking their allocations from and putting it to Bitcoin instead, reallocating their capital? That's one part of it, right? Really important part of it, though, is that where's the puck going? Where's that $900 trillion going to be in 10 years? Is it going to be 920 trillion? Or is it going to be closer to quadrillion, which you thought it's going to be
1.6 quadrillion by 2030?
Yeah. So we're talking about 5 years from now.
Yeah.
It's a massive move, but that's probably, I mean, I would say that's right in the range. It's
not that big. It's 30 or 40%.
That's it, which is money supply 7 or 8% between now and then. There you are, right? So, so that's it. So
if the money supply goes up by 8% a year for the next 5 years, where are we at?
Where are we at? Exactly.
Yeah.
That's exactly right. So that's pretty base case. It could go up a lot faster than that.
Yeah.
Right? The money supply could expand a lot faster than that, especially if we have another market shock,
right,
like we had in 2020. So if they print 50% of the money again, I mean,
yeah,
I mean, that'll shoot up really quickly. You better own some assets. You better own some Bitcoin. So, so where's Bitcoin going to take market share away from? Well, it's obvious that it takes market share away from gold and from stocks. Well, you've got people who feel like it's hard money and it's digital gold 2.0, and you've got people who feel like it's just a risk asset and they're speculating with it. So it's taking kind of market share from both of those. So gold isn't growing as fast as I think it would if Bitcoin wasn't there, right? And then you've got the institutions that are suddenly waking up and seeing that, well, the Fed lowers interest rates by a full percentage point over the fall, and the 10-year bond yield goes up a full percentage point. Why is that? Well, because bond investors want to be compensated properly for the risk they're taking in holding those bonds. And they want a higher yield down the road because they know that the money supply is going to be expanded a little bit faster than people are expecting. And because they know that the Treasury is just going to keep dumping bonds on the market. There's going to be massive amounts of bonds. So that's a really easy, clear bucket for Bitcoin to start taking market share away from as well, because institutions are, and we're seeing it in the different companies establishing a Bitcoin treasury. They want Bitcoin in their treasury. Why? Why wouldn't you just hold 10-year bonds? Why wouldn't you just hold 30-year bonds or T-bills? Well, T-bills have reinvestment risk. Once you get paid back, where the interest rate's going to be, number one. We saw what happened to 10-year, 20-year, 30-year treasury holders during the last cycle in 2020. They got obliterated.
Yeah.
Had the worst bond losses in the history of the bond market. So that's a risk. That's duration risk. Well, if you own Bitcoin, yeah, it's volatile, but it's volatile to the upside.
Right.
So
it's a big difference.
It's a big difference. So it's okay. The volatility is okay because over a longer period of time, it's going to appreciate faster than the dollar depreciates, basically.
Right.
And that's the trust. And so it's easy to take market share from that bucket. So you can see that the pie is growing and Bitcoin's share of that pie is growing at the same time. So,
yeah. I want to ask you about a recent conversation you had with Michael Howell.
Yeah.
Who's, I don't know, maybe the king of global liquidity. I don't know.
He's a very smart guy.
I'll call him that. I don't know if he is. He's the one that has been talking about the longest, in my opinion, from what I've been watching. But, he makes a strong case that that global liquidity moves in cycles, and that it moves the denominator, which then moves the nominator, right? So it's like the price of the S&P 500 and the price of homes and the price of Bitcoin all go up when you continue to increase the denominator, increase the fiat. So he talks about, like I said, these liquidity cycles. I didn't hear the conversation, but I'm just curious if you guys talked about where, Bitcoin has these 4-year cycles. And what's interesting is a lot of people today are saying that the cycles are broken. The 4-year cycle's over. It's not going to happen anymore. I remember Saylor saying all your cycles were broken last cycle, and that
all your models,
all the models were broken. That didn't seem to stop it. People are now saying that because now we have the ETFs buying, we have the sovereigns buying. They're not going to be selling. You mentioned earlier they're not price sensitive, so they're buying, they're holding. They're not like the hedge funds that will be trading around it most likely. So anyway, a lot of people are calling for that. I tend to think that maybe it's not the 4-year cycle, the halving cycle, that drives the prices up and down like that, but the global liquidity cycles that's doing it. So regardless of what's happened in the Bitcoin ecosystem, if long-term holders hold it and don't sell it, I think it's kind of captured by this liquidity cycle. I'm curious, after talking with Michael Howell, what your opinion is on that.
Yeah, it's a good question. And I think, also could be, funny enough, it could also be centered a little bit around the election cycles, because the election cycles could also drive the liquidity cycles.
Yep.
And the election cycles bring a lot of uncertainty. And once you get certainty in the market, just like we saw in this past fall, when you had certainty that Trump was going to be elected and that he is elected, well, Bitcoin ripped. It went from 60 to 90, 100 plus thousand. And so why is that? Well, there's a few reasons. You take uncertainty out of the market, which market hates uncertainty, and then you actually inject optimism because you had such a terrible administration prior to this.
Yeah.
The Biden administration was abysmal for digital assets and for cryptocurrencies
and business overall.
So you have that's positive, right? The other thing that what Michael and I talked about, though, is exactly what you said, is that cycle, right? So the liquidity cycle actually, it dipped down and bottomed out in about October of 22. And since then it's been rising again slowly. You have periods like we had in December and January where liquidity was kind of rolled over, or November to December kind of rolled over. Well, central banks were not expanding their the liquidity at the rate that they were before. So you do have these blips in between. But overall, we're on the upswing. And and I agree with Michael. He expects that liquidity cycle to go on the upswing and top out in mid-2026. So that's funny that you say that, because I would say, not even thinking about just Michael Howell's chart, but thinking about that Bitcoin liquidity cycle, that seems to fit exactly with what people are thinking, that we'll really hit the top here at the end of 2025 into the middle of 2026. And that would kind of dovetail nicely. The only stipulation there, and the only kind of hesitation I have with it moving exactly with that cycle, is Bitcoin tends to lag. So Bitcoin lags 6 to 8 weeks, maybe even longer, maybe 8 to 12 weeks on that liquidity. So liquidity has to come into the market, and then it finds its way into Bitcoin.
Yeah.
And so when you put Bitcoin up against, say, something like M2, or Michael Howell has a chart where he shows it up against, and he's got it lagging, so he shows it right up against there. It really does follow that liquidity pretty closely.
But it seems like the upswing on Bitcoin has that lag, but then the drop almost front runs it.
Yeah, the drop is precipitous.
right?
You've got to be really careful and understand what you're doing.
If you looked at when Jerome Powell announced that they were going to start raising rates, was that October, November of 21, I believe. I think that's
right. And in 22 they were raising,
and it was like January or March, then they started raising it. But they announced it right in their forward guidance, telling you what was going to happen. And Bitcoin sold off immediately.
Yeah.
And then the NASDAQ was like a week or two later. But the S&P 500 didn't sell off for until January.
Right. Well, Bitcoin has been the tip of the risk spear. Yeah. So people, and what I mean by that is that it has been the point of vision, like the point of view of, and the visibility, forward-looking liquidity. And so it's exactly what you just said. And so, you can't wait for Michael Howell's chart to come out to say that liquidity is top, it's coming back down.
Right.
You're going to see it in Bitcoin.
Yeah.
Now, I don't believe that Bitcoin remains as volatile as it is today in the future. I think that volatility is going to dampen. We're not going to see 80% drawdowns.
But is that a bad thing or a good thing?
Well, it's a good thing for the store of long-term value, right? And because it shortens that length that you have to hold it to be sure that you'll get your store of value. And so that's a good thing. And but it's just a natural thing. When you have institutions that are investing trillions of dollars into this protocol now, not just millions, hundreds of millions, but trillions of dollars. Now you've got this liquidity in this asset that it kind of puts bumpers on it, right? So what I mean by that is that an institution will own a position. They'll get their percentage position. Say you're, a very large endowment and you've got a $1 billion, or let's call it $100 million position in Bitcoin. And so you've got your $100 million and it's a percentage of your portfolio. Well, if Bitcoin is in its cycle and it goes up to $200-300 million, well, now it's not just 1% of your portfolio, but it's 2-3%. Mm-hmm. Now, if you're supposed to only have 1% in your portfolio, you're going to pare back. So it's going to kind of clip that euphoria FOMO high, in that you'll have these institutions selling into that.
Yeah.
And then when it comes back down, the rest of your portfolio will catch up and it'll come back down, and then you'll now...
Who sells their winners and holds their losers? What kind of world is that?
These institutions, they pare it back just to manage their exposure in their portfolio. It's almost algorithmic.
Yeah.
And so then when it comes back, they'll add to it to, top it back up and get it into that right percentage of exposure they want in their portfolio. And so that'll dampen the downside. So it'll kind of put some bumpers on it. That's a little ways off. I don't think it's going to happen in this cycle, but I do believe the next cycle, we're really going to see the impact of that.
Yeah. I was always told to let your winners run long. Cut your losers short. All right, James, last question. We've been talking sort of like these 5-year cycles. Let's start there. So if we fast forward 5 years, if someone listening here ignores everything we talked about today and just keeps investing the way they always have, what happens to them?
In 5 years, and it depends on how are they investing. Let's ask that.
They're dollar cost averaging into their mutual funds.
I mean, I think that they'll be okay. They'll probably keep up mostly with the expansion of money supply, but the problem is in these cycles you'll have these massive drawdowns, and you don't have the ability to move around your capital swiftly. I would say that Bitcoin is that's why we're focused on Bitcoin in particular, because I believe that it's going to grow faster than any other asset class in the world, and it's going to continue to do that for a while. And so if you're not exposed to it, I think that you're at a disadvantage in your portfolio. And this is what I tell institutions in particular, family offices, and which, this is funny because they're starting to realize this. They're coming to us and saying, "Hey, do you have capacity in that first fund?" No, the first fund's closed. That's why one of the reasons we're opening up the second fund is because we have people coming to us and saying, I need to have some exposure. I don't really know exactly how to get exposure in the space myself. And I want to do more than just buy Bitcoin. So, and so what's really important about this is that when you have exposure to Bitcoin in your portfolio, then it not only raises your returns, Mark, but you know this, you've seen the numbers, it raises your Sharpe ratio, which means that it provides a better risk-adjusted return to your portfolio, which is what we just talked about,
right? Because
Bitcoin will become uncorrelated to the other assets and be growing faster than them at the same time. I mean, what a great way to enhance your portfolio.
Yeah.
Right. So the people who do that, I believe, are going to be much better off in 10 years than the people 5 or 10 years than the people who don't.
Yeah. Especially if, per my calculation, I won't put you on the spot. Per my calculation, I think Bitcoin has a 10x in front of it over the next 5 years. So, yeah.
Mine's the next 7.
Yeah. So if you
10x the next 7.
The problem with the mutual funds is that even if they do keep up with the rate of debasement and they average 7% over the next period, one, that's not the real number. Two, the fees. Most people only get about a third of the profits. About 2/3 of those profits go to the administrators and the managers. So, cool. Well, let's wrap it up with that. The Bitcoin Opportunity Fund, James, fund number 2. We talked about that. We're going to link to that in the show notes down below. If anybody wants to get a better risk-adjusted return, add it to their Bitcoin profile, and doesn't want to be regretful in 5 years, check it out.
I appreciate it, Mark. I look forward to the next time.
All right, thanks.